Good afternoon to all. We'll let a few more people trickle in and then we'll just get started.
Great to see you, Ted.
Good to see you too, Neal. I was just on the Charlotte XPX group and just catching up there, and I saw there was somebody else there I thought might have been at least if not a partner or in the same organization of VR there. So.
Yeah.
Wow, it's been a long time since I've seen you, Neal. Saw you this morning.
Good to see you, Eileen.
I'm going to give everybody a warning right now. I've got to leave here in about 15 minutes, but I want to catch as much as I could because in 15 minutes I kick off the Financial Executives Networking Group meeting. So I want to catch as much as I can today. So.
Yeah, very good. Well, we'll just get started. Good afternoon to everyone. We are extremely grateful that you are able to join us today. My name is Luis Feliz, and I'm the Hispanic Community Liaison Coordinator for the Better Business Bureau of Eastern North Carolina. And I just want to welcome all of you guys to our virtual Lunch and Learn, Keeping Your Business Ready to Sell. And it's hosted by us, the Better Business Bureau, and Neal Isaac. And without any further ado, I want to present to you guys, it's my pleasure to present Neal Isaac. And just to give you a little bit of background, he is a managing partner of VR Business Brokers. And today you will be learning about what buyers are asking for when evaluating a business opportunity and how to gain the probable sales prices you're hoping for. So at the end, Neal's going to leave some time for Q&A, and feel free to unmute your mics, or you can even go to the chat box and just type in your questions there. So thank you, Neal.
Wonderful. Hey, thanks everybody for joining. And this should be I'm glad we got an intimate group here. This should be a fun presentation. I do a lot of presentations, and I've kind of mashed together a few to get this topic of keeping your business ready to sell. So I got just a couple, I'll call this my preamble, and then I'll share a short slide deck. You know, this is going to kind of cover some of the quantitative, the numbers-driven stuff, but also the qualitative piece, some of the emotional parts of being ready to sell, because, you know, that's really what it's all about. This notion of transferability of a business. I will say that I talk to owners every day, and the majority of them are not ready. They're not ready to be transferred. And I will put my own business in that category, and I'll speak to that as part of my presentation. So that's kind of my preamble. Let me see if I can share my screen here, and I'll just jump right into it. And we'll keep this super informal. If you guys have questions, please just interrupt me, and I'll answer your questions on the fly, or you can save them to the end, whatever works for you. Okay, so you can see my entry slide here. Is that correct? Cool. Okay, so this is our topic: keeping your business ready to sell. And there we go. About me, I am actively selling businesses here in the Triangle. I'm a business broker, intermediary in the Main Street space primarily. I have M&A capacities, so I can do the $10-20 million deals, but majority of my deals are deals like I had a small tropical fish business where I sold Nemo and Dory here in Garner, and I sold that business, and that's what we consider a Main Street business deal, and that's what the majority of small business is. So that's kind of the target audience here. And I kind of mentioned this. I'm a business owner. I'm actively juggling the operations of my business and the vision of what I'll call the execution of the vision. Where do I want my business to be? What is my exit plan? And how am I making progress towards having my options for exit while I'm operating my business? That's where most of us, I would say, are. And finally, and Louis and I were talking about this, I'm a family man. I've got a 2-year-old. So I'm trying to balance the demands of running a business with being a good dad and some semblance of a normal life as entrepreneurs. We all struggle with that. And that actually does tie in with value of how dependent your business is on you, how much that comes into transferability. If you are the business, I got news for you. It's gonna be an uphill battle. So let me open it up with this picture. And forgive me because my thing is running kind of slow here. Okay, here's a speedometer. I just want to put this visual in your mind. Everybody calls me and they, I do valuations, but they're always pressing me for a metric. What's this thing worth, Neal? Give me a ballpark. And so I have one for you, and I'm going to give this to you now. And I'm going to give you actual numbers so you can value your own business in just a couple of sentences. Of course, there's a lot of details and nuances here, but I will tell you that 90% of businesses in the Main Street space, 90% plus, if the owner is keeping $50,000 a year up to $200,000 a year, if they're keeping, not the top line, but the bottom line, 90% of those will sell for 1 to 3 times their earnings. So on our little chart here, your speedometer is going to start, this is at the 75% of 1. It's going to start here. Maybe we'll get up to here, the 3. 1 to 3x, 90%. So for a business that does I intentionally left a big gap there, right? For a business that does $100,000, I'm saying maybe it's worth $100,000. That's 1x. But maybe it's worth $300,000. That's 3x. And that's as simple as I can make these valuation exercises that we do. It's a multiple cash flow. Now, what the cash flow is, there's some math involved in that. But unless you're just selling for assets, and I know I'm getting deep into valuation here quickly, but unless your business just selling off your desk and stuff, you're probably going to fall somewhere in that. So now that we just hit that straight out, like we got to the quantitative stuff, let's back up a little bit. Let's talk about why it may be worth 1 or less, or why it'd be worth 3x or more. So in this next 20 minutes or so, I want to talk about this journey that owners go on, the emotional journey, and this is based in science. I'm going to talk about kind of the heart of this program, what buyers will look at. By the way, it's different than what owners of businesses, what sellers, how they look at their business. Buyers have a very specific lens they will look at your business through. And then I'll kind of wrap things up with some takeaways of just lessons I've learned from talking to hundreds of owners. Do I have a mutual consent from everybody here in the room? Is that a good agenda? This is how I do my meetings. Are we all on the same page? You weren't here for the hula hooping class, right? Okay, we're all on the same page here. Eileen, thanks for the smile. Okay, so here's a graph, and again, this is based in science. Whether you know it or not, when you start a business, these are the different stages inevitably you will probably go through. When you start your business, you're just going to be like, woo, this is great. I'm the next empire with my business. There is nothing stopping me. And inevitably, whether you realize it or not, and that's the key, you will plateau with your business. You will reach a phase where you're like, I worked really hard and I'm making money now, hopefully. And not sure I want to work harder because I'm kind of comfortable right here. And inevitably, if you don't do something, you either work harder or you coast too much, you will reach this transition phase where you're just like, where's Neal? I want to sell this. Or I'm looking at you, son or daughter, to take this over. You will reach this transition phase. Inevitably, every owner goes through this arc. This is the arc of psychological milestones. We're not talking about numbers anymore. We're very much on what it feels like, right, to own a business. So why do people sell their businesses? Well, here's some more research. I'm very involved in my associations. The International Business Brokers Association puts together this resource. They ask brokers like me why all of their clients sold. So it's based in real deals. And as you can see, people either retire or they find something else that's a better use of their time. Quite often I call them the young hustlers, where they're 30 years old and they build a business, they're making money, and they just don't feel themselves challenged anymore. They say, well, I could do real estate and have passive income. They'll sell a business for that reason. Or burnout. And I think burnout toggles with the number 2 reason outside of retirement. So these are obviously dependent on age. But rarely does someone come to my office when they're not suffering from one of these 3. The lagging one would be personal issues like divorce, or just personal situations would probably be number 4 on this list. So we know that people make money. We know that they go through these phases, and we know that ultimately these are the reasons why they end up deciding to sell. So now let's pivot to what buyers want. And I'm going to spend more time on this section because I think this is the heart of our presentation today. And I'll share with you. They want, I call it the 3 Ps. The 3 Ps are people, profit, and processes. But this is another way of saying it. Clean records. I'm going to spend a lot of time on records, and Ted could talk to you a lot about what clean records look like. Now, more than ever, they want a strong team. I'm talking about like today, like August of 2021. I hear this more now than I've ever heard. I've always heard it, like you can't sell a business if it's a one-man band or just a single operator. It's extremely hard to sell. But now ever, with what's going on with COVID and the incentives that people have to get unemployment, it is extremely hard. And people will buy a business because they see that an owner has put together a strong team of people. So that's topical. It's germane to right now. And then this third element, it's harder to really circle this, but the secret sauce. The secret sauce is the intellectual property, right? This is things like documenting your systems, books and records. I've had business buyers look at the numbers, meet the team, and then say, well, have they documented how they do this? If I go on vacation, is there a flow chart for what to do if I bring in a new manager? Can I give them a book that tells them how to hire and fire and what our processes are? And when the answer is yes, we have that, there's more value there. It gives buyers a more confidence, right? And I would put in this same category the age of the business. If a business, going back to that 1 to 3 time multiple, if a business makes a lot of money and maybe they built a strong team, if they just did that in 6 months, it's going to be worth far less than a business that's more than 3 years old. And I see that a lot. People throw these businesses up and they do great really quickly. And they're like, I'm ready to sell. I haven't even gotten 1 tax return yet, but look at all the money we make. Business buyers will look at that and they'll say, well, why give this money to this owner? Because in 6 months, it looks like I could do the same thing. So when I say secret sauce, I'm talking about documenting your processes, getting some time under the belt, and solidifying your intellectual property into making it unique. So this is more of the qualitative piece. So we're getting away from the numbers a little bit, but that's kind of the goodwill, if you will, of the business, the secret sauce. All right, so let me spend a little bit more time on this clean records piece. What does a buyer do when they buy a business? Well, they do their due diligence, right? We've heard this term, due diligence. What is due diligence? Well, I got news for you. They want to look at they want to know how you make your money in painful detail, right? So a lot of deals that are done are not done through business brokers, not done. I'm an intermediary. I represent sellers and I will take their data and I will extrapolate it and have a presentation. We'll have a staged release of data. And in the format that we want to release data so that we know that it's appropriate to what buyers will want to do tax returns. If it's not on your returns, then you may not be able to financing for your business. You'll have less buyers. They'll your financial statements, so your profit and loss, your balance sheet, those should tie into the tax. But ultimately, they want to see it on your bank statements. They're probably not going to believe. In due diligence, there will be a time when most buyers will say, "Show me the bank statements." This is part of selling. Your own manager producing a loan will want some of your W-2s and so forth. When you buy a business, it's a process. How do we verify that? If your business is SBA financeable, that means that you will probably get most of your consideration at closing. Most owners who sell a business, that'll be a good solution for both parties. I hope you guys can hear me. I'm hearing a lot of recording noises, but I'm going to soldier through here. So anyway, that's a little bit about financing. That's how due diligence works. And some people are surprised to hear that. If you're not working with a business broker and intermediary, I would just say be careful about who you share this type of data with. You should be very confident that they have money and they can consummate the deal. So that's all I want to share regarding how due diligence works. But I will also say this. Business buyers are very focused on how you make your money. I'll just use my firm, for example. I make money only in two ways. I sell valuations and I make money from success fees. But if I add a third service like consulting in my financial statements, I would want to add a new line of my income statement that says consulting revenues. That's a part of my financial story. And if I were to sell my business, I guarantee a business buyer will want to know exactly where my money comes from. It's pretty common for owners to break out their expenses, to say, oh, we spent this much on rent, we spent this much on payroll, and here's where we went out to eat, and all of those details for expenses. But it's pretty common for owners not to detail out how they make their money. So I would highly encourage that. Buyers are extremely interested in how you make your money, detailed breakout of that. And I wanted to mention a payroll. How you choose to pay your employees makes a big difference, whether you choose to go with the independent contractor route or the W-2 route, as well as how much you pay yourself, the owner. Now, I will say this, it doesn't matter how much you pay yourself as the owner. When we figure out what the cash flow of a business is, we consider any monies that go to an owner to be cash flow. But what does matter is if you are, as the owner, are doing an inordinate amount of work, more work, like if you should have hired someone to replace yourself, but you haven't done that, you don't have appropriate payroll, and that's why your business is so profitable, that will definitely hurt your business value. So if you're thinking about like what's appropriate payroll, this is something that should be pretty easy to look up for your industry. Eileen, you're in the travel industry. You may be able to look up travel companies, and the average travel company, if it does, I'll use $1 million as an example. Do they spend $100,000 on payroll, or do they spend $200,000? I don't know what that answer is, but if you're looking at your company and you spend $50,000, maybe you're keeping a lot, but if you're going to sell your business, I just picked on you, Eileen, because I can see you. But for any business, you can go through this exercise and just say, what do people expect to pay on payroll? Sometimes businesses are too profitable, and it's because the owner is doing inordinate share of work. So that's all I have to say about payroll. And then this idea of realistic, steady growth. Sometimes I see businesses and they do this hockey stick type earnings or sales. Sounds great. We did $100,000 for 10 years, and then last year we did $1 million. We just did $1 million. Sounds really good, and technically you're a $1 million revenue company. But is it sustainable? That's an answer that you'll need to have. So, because maybe it is, but buyers will be suspicious. And I think we spent some time on clean and consistent books and records. So let me move on from this point. We talked a lot about due diligence. Do I have any questions at this point? I know I spent a lot of time on this particular slide. I'll move forward from this point unless you guys have any questions on that. I'll pause for just a minute. Keep it interactive. Okay. Well, let's look at a chart here. I'm going to come back to the other chart that I showed you. I'm going to put those together. But let's look at this. I did a done deal search, and I can't remember. It's been so long since I put this together, but I found a ton of companies. And down here at the bottom is how much these owners made. Down here, $50,000, $100 grand, all the way up to these owners, they cash flow what it was worth to the owner was $500,000 per year. And over here, we see this, how much did they sell their business for? This is not for sale. These are sold business comps. And now let's just look at what these owners got. On aggregate, lots of different industries. I shared some of these multiples at the beginning of the program, but in this case, these owners that earned a couple $100,000 per year, they sold for 2x. They got 400,000. Here, these owners got on aggregate 900,000. I'll point out there's always outliers. This guy or girl exceeded the average, and this poor guy or girl could have probably sold for more based on their peers. But we're looking at a pattern here, and it just gets better with time. The more owners make, the more excited, the more exuberant business buyers are to pay for the future. That's how this chart works. And I want to revisit this chart. I'm going to toggle back and forth here. I'm doing this on purpose to show how these things intersect. Because remember we talked about our owner who reached the top of the mountain and they didn't want to climb anymore? Well, what if that owner had just reached the $300,000 mark, but they want $1.5 million for their business? The last thing they need to do is go into this transition phase and take their foot off the gas pedal. These two charts, this chart is up into this right corner here, and this chart is kind of down into the bottom of the right corner. That's a major issue. If there's one thing I want you to take away from my presentation here, it is this, that if you're at the plateau phase, a lot of people come to my office and they say, hey, I want $1.5 million for my business, and I earn $300,000. Well, all your peers are selling for $900,000. Are you too past your point of plateau to grow the business more? Oftentimes the answer is, yeah, I am. Now we got a challenge on our hands, right? It's better if you're in the building phase to come to me and say, I want to sell for 1.5 million, but I only make $300,000. Now we've got some room to grow. But just knowing where you are in this chart is extremely important. And that's not a money thing. That's a personal thing. So I want to share just a few more, I call these notable considerations, and I got a few more points, and then I'll start to kind of wrap things up. So I apologize for the text on the screen. It's hard to make this stuff look pretty, but I will talk about working capital. As your business gets bigger, business buyers will start to look at how much it costs to run your business. And in the case of these folks that are starting to earn, when you get over $1 million, we get close to $2 million, $3 million per year, all of a sudden it doesn't cost you. You don't have to keep 10 grand in the bank each month to make sure you can clear your payroll. Now you have to keep, 100 grand, 200 grand, 300 grand every month just to cover your monthly expenses. That's what I'm talking about with working capital. So as businesses get bigger, working capital becomes more and more important. It's just something to think about. Also, if you're thinking about keeping your business ready to sell, once your business gets big enough, it's extremely important to start thinking about shifting from cash accounting to accrual accounting. Accrual accounting is a more accurate picture of your earnings. So something to talk to your accountant about, whether it's time to shift over to accrual accounting. It's not appropriate for every business, but especially project-based businesses, it can be super important. I had touched on employees before. I'll circle back and just say that in general, if you're going to make a hiring decision, if part of your goal is to sell your business, independent contractors 100% definitely give you some flexibility and help you know your costs a little bit better. But W-2 employees, like secret sauce, intellectual property type stuff, we have a team. They're all W-2 employees. There's more credence there in general than these are all independent contractors. They work for us. They work for other people. They're not employees. Sometimes that's better for me. But if you're looking at your options for exit, they're more comfortable if the employees are W. I did touch on this as well. Business should be in line with the benchmarks for his industry. I referenced this to what him or her, but I would also say look at all of your metrics. It's going to raise a red flag. It's like too true story. I took a company to market, and they did $6 million a year, and they kept $1.5 million out of $5 million. So I don't know what that margin is. It's 25%, something like that. I talked to I shopped it around. Everybody said there's no way they make that kind of money. I'm in the same. We keep $500,000 on $5 million. Keep 10%. How are they keeping much more margin? And they were selling drugs out the back door. That's what this industry specialist said regarding how this company was so profitable. He wasn't saying that my client was doing that. He was just saying it was highly irregular for this type of company to keep those kind of margins. So it's just something to look at. What are your peers? What are the KPIs for your business? And does your business line up? Just know what your peers doing is what I'm advocating for. People like to buy boring businesses that are very predictable so that they can build a business model. And if something's out of line, they're gonna be suspicious. And then lastly, on this notable considerations piece, it's pretty common when you're running a business to write off aspects of the business for, we call it tax mitigation purposes. You know, nobody wants to pay taxes. So where can you enjoy the benefits of business ownership and expense personal items through the business? So some good categories are things like buying life insurance or health insurance, having a personal vehicle. These are things you can talk with your CPA about, and it is an appropriate place to enjoy the benefits of entrepreneurship, which is the greatest tax write-off opportunity. I've heard it described that way. But the cost of goods, it's not uncommon for restaurant owners to go to Sam's and have two shopping carts, and one shopping cart is for their restaurant and one shopping cart is for their home. That happens. I'm sure it happens. It is not a good way to show that your business makes money. When it gets to my hands and I'm doing a financial analysis, it's going to be impossible for me to convince a buyer that they're going to make that money. So I like to point that out. I've had a lot of bankers tell me that cost of goods is the worst place to put discretionary earnings. And then I got a couple more things. This just came up recently. When you're growing a business, I want to talk just about assets. So if you own a business and you have vehicles, heavy equipment, maybe it's a construction company, maybe you have asset management is a topic I want to address before I wrap things up and get to my takeaways. It's very important to know that when you sell a business, there's really only two ways to sell it as far as value goes. I talked about this multiple of earnings approach. 1 to 3x is the multiples that I gave at the beginning of this presentation. That's basically selling for the cash flow of the business. Let's say your business makes $500,000 and I'm going to pay you $1.5 million to buy the opportunity to make $500,000 a year. That's how a multiple of cash flow works. There's an assumption there that if I'm buying your business, I'm going to get all of your assets. I need that truck that you have to make that money. So managing your assets becomes a significant factor. Here's what I mean by that. A lot of times, it happens a lot, owners will accumulate assets. They will buy lots of fun toys, forklifts, vehicles, skid steers. I've seen lots of it. And they just say, yeah, we had a really good use, so we bought some new equipment. And then I tell them, well, congrats on making $500,000. You're going to sell your business for $1.5 million. Oh, and by the way, the buyer's going to get your skid steer and your trucks. They need all this stuff to make the $500,000. And the owners usually say, well, I'm fine with accepting $1.5 million, but they're not going to get my stuff. That's my stuff. This is the point I want to make about asset management. Every asset that you buy in a business should contribute to the cash flow. A lot of owners, they end up with too many assets that they're just kind of toys, and they're not producing a return on their investment. So that makes for a complicated reconciliation when we go to take these things apart. So just be mindful that your assets should be returning on investment. And if you have too many assets, the solution is, if you want to sell your business, sell off the assets that aren't contributing to making money. Those are not, you should have to transfer those if they're not a part of the business. And then the one final point I want to make, because I've seen this a lot too, is not about assets, but it's about giving away equity. So quite often people will come to my office. I had it recently, a very impressive young woman came to my office and she had 3 locations. And this exact example I've been using, she made $500,000 per year in cash flow. And I said, congratulations. I think you can get $1.5 million, maybe more for your business. To which she said, I want $10 million. And I'm not afraid to go to 10 locations or more. That's what success looks like to me. And my response was, that's awesome, because I want to sell your business for $10 million too. Let's go do this. And so she decided to grow her business. She's going to sell later. But she also told me, I need a CEO. I'm going to hire a management team, which makes sense. If you're going to go to a $10 million company, it's hard to do that alone. My suggestion to her and to anybody who's going to go down this route, she then mentioned she wanted to incentivize that individual, and she's going to give them a part of the company. I think that's smart to install a management team. I think it's super smart to incentivize them to grow their company. But I would highly, highly encourage, if you're thinking about giving away equity in a company, to understand what an operating agreement is and to make sure that you talk with an attorney about these type of arrangements, right? So it's an operating agreement is basically, to distill it down to its most simple term, it's a prenuptial for a business arrangement. It's basically saying, this is how we're going to run this company. And if we're not running this company together, this is how we're going to go our separate ways. So in this example of this owner who said, I'm going to go to 10 million, I'm going to sell them, and I'm going to bring in a CEO, it's important that this owner has an operating agreement with this new CEO who, if they get some type of stock, that they can't preclude her from her stated goal of selling her company at 10 million. So I hear that a lot, where owners say, it's not enough, I want more, I'm going to grow, I'm going to install people. Be careful about the equity that you give away. That's my point. That's my final point there on this topic of just random things on growing a business with your plan to sell. And so at this point, I'll just give you these takeaways, and then I'll open it up for questions. I promised Lewis that I would talk for 30 minutes at the most, 35 minutes at the most. So I think you've heard it by now. Just be aware that your business, just like people, businesses do not last forever. They could last forever. There are some businesses that are hundreds of years old. It's pretty rare. The people that run them don't last forever. And those are big businesses. But most businesses, they're somewhere between getting started and getting out. So just being aware of where you are in that stage, super, super important. And this whole time we've been talking about planning for the future and thinking about ways to make your business more valuable through solidifying the intellectual property of your business, to showing how you make your money, and to building a strong team. And last but not least, some of these things I talked about, I mentioned, talking with an attorney, talking with your CPA, share your goals with your advisors. Super important. Too often I will talk with an owner who wants to sell, and then I'll meet their CPA, and it's a friend of mine, and they'll say, Neal, if I'd known they wanted to sell, we would have done things differently. They didn't talk to me about this. Well, now you're not going to get as much as you wanted for your business because you didn't share your goals with your advisors. So I consider myself an advisor to my clients, but I want my clients to be communicating with all of their advisors. Too often I'm the first one to find out that an owner wants to sell. And then we have to work with what we've gotten. Once you put in a tax return, it's pretty much concrete. Can't change that. You can, but it's normally not a good idea. I'm going to pivot to questions, and I'll give it back to Lewis. These are some of the ways that you can find me, RaleighBusinessBroker.com and via Biz Triangle, or most of my social handles. I put a ton of videos out on YouTube. You can look that up. And yeah, that's everything that I wanted to share with you. In fact, I'm going to go ahead and stop sharing now so I can go full screen again. And with that, I will give it back to you, Lewis.
Thank you so much, Neal. And I apologize for the in and out. We were having technical difficulties here in the BBB office.
No problem.
But we'll leave this time for some Q&As. If you guys have any questions, please unmute yourselves, or feel free to write the questions that you have for Neal in the chat box.
Do you ever have anybody, like, instead of selling it, they just like give the company, they're still in control, like they're getting residual? Like, what's that called? I mean,
Yes. I'm so glad you asked that question, Eileen. I want to point out, in answering your question, I will say that as a business broker, we're focused on third-party transactions, which is a minority of deals. A lot of deals are a father passing a business to a son or a daughter, or an owner sharing equity with one or multiple team members. That type of stuff happens all the time. And that gets back to these, I mentioned an operating agreement. That's still a transition deal, but it's within, it's an internal type deal. You'd still want to get a valuation done to figure out what the going concern value is. And then you've already got your buyer in that scenario. So you just need to figure out a method that makes sense for everybody. Like, how is the total consideration going to be conveyed? And in return for the equity that you keep, how are you compensated for that? So those are complicated arrangements, but that's probably a more common way that companies are transitioned than a third party exit.
yeah, because right now my team is all independent, right? Because I have a host agency, and that's how they come in. So they're not W-2.
Yeah.
So
yeah. And that's not bad. And when I mentioned W-2, like almost every real estate office is independent contractor arrangements. It's not to say that is the best for all industries, but a lot of companies, people are looking for that.
yeah. And we're kind of like real estate, we're just sell a different product. Yeah.
The business brokerage industry is exactly the same. Exactly the same. But like, if you were to get bigger and start to hire administrative support, there's a scenario where it may make sense to look at bringing them on as W-2. Like in your scenario, if you're considering, what it would look like to an outside party. If you say, I've got to administer, oh wow, that sounds like a pretty good process there for support. Back office support is going to stick around.
Okay. Thank you.
Good question. You're welcome.
This is Bruce. Can you speak more about the reasons for and the situations that you would switch to accrual-based accounting?
So on cash first, accrual accounting, because it took me a long time to understand this, but I am doing project-based work especially, and I sell a job today, but then I do the work tomorrow. Cash accounting, the business, if I'm collecting money tomorrow, today the business doesn't show that it's made the money. So the reason why accrual accounting is superior is showing that maybe you haven't collected them yet. Those are a complicating factor is that tax return accounting and the finance, the banks are only looking at that. So even if you run your business in accrual, we're really just looking at it to show the detailed pictures. The last note on that is, if you got that money coming to you, and if you sell your business, part of the reconciliation is you're going to collect on all that work that you already did on top of your purchase price. So it's just a accuracy of financials. Oh, good. Thanks for joining. Lewis, you were jumping around, buddy. You just moved from one Brady square down to the middle.
I am so sorry, guys. I do not know what's going on with the internet. I apologize.